Good morning. Thank you for joining us for Capstone Coffee Conversation. My name is Ryan Skogstad. I am here in the Salem office today. And then Brian Felshaw is going to be joining us as well, and he's up in the Silverdale office. And so we're going to do a little bit of a back and forth handoff to each other. So if you set your Zoom up for speaker view, then you'll see myself sometimes if I'm speaking, or you'll see Brian if he is speaking. But that's a good way to set up your Zoom. We're going to try and do a little recap as we start off 2024. So we'll do a little recap of 2023 and what's happened, and Brian's going to lead us through and how the year went, and then he'll pass it back to myself, and we'll look at where we stand today as we enter 2024 and some things that we're looking forward as we enter this year. As always, if you have questions, please submit those to the host. You can just send a little chat message, and Kennedy will read those questions off after we conclude, and we'll see if we can get to some questions that you may have. So feel free to just chat those in. So without further ado, I'm going to hand it off to Brian. Brian, if you would, give us a little recap of 2023 and what went on throughout the year.
Thank you, Ryan. 2023 really was a banner year for stocks in particular. We really ended the year up well into the double digits, but the journey to get there was really a roller coaster. Starting in 2022, we had stocks come down quite a bit, hit a bottom in October, and then started some momentum towards the upside, and really carried that through January through summertime of 2023. The market came up quite a bit, and then in the latter half of the year, we saw some ups and downs. Right about July, end of summertime, we saw the market sell off and hit another bottom in October. And then in the fourth quarter, we saw one of the best rallies we've seen in the last 15 years. To give you some numbers for this, from the bottom in October that we had in 2023, the S&P 500 was up 12.5% in 2 months. The Dow was up 13% in 2 months. And small cap companies rallied 20% in the last 2 months of the year. So we had kind of a peak in July, gave back a lot of those gains, and then in the last 2 months of the year, got them all right back. So the S&P 500 ended the year up 24% through those ups and downs. Now, in the past couple meetings, we've talked about something called the equal weighted S&P 500, where we had instead of all the companies being weighted with how big they are, they're all equally weighted. And yes, the equal weight S&P was up 13.7%. So we really saw those top heavy, magnificent 7 companies that we've been talking about the last couple of months really carry the load and get us to that 24% up for the market. Along the way, we saw interest rates really seesaw back and forth with stocks throughout the year. The 10-year Treasury rate started the year at about 3.7%, and was pretty flat, not much change throughout the summer. But by the end of September and into October, just as stocks were bottoming, we saw the 10-year Treasury rate reach a multi-decade high of 5%. And that was pretty appetizing, it seemed, for investors to start buying the 10-year Treasury rate, because as we saw stocks bottom and those interest rates on the 10-year Treasury hit a high, they started to reverse again. And we saw investors buying those 5% 10-year Treasury bonds, and that rate started to come down. By the end of the year, it was at 3.8%. So when we saw stocks rally plus 10% in the last 2 months of the year, we also saw interest rates fall about a whole percentage point down to 3.8 by the end of the year. So lots of seesawing back and forth with interest rates and stocks. Some other notable things to look at. International stocks, despite all the tensions and wars that we've seen the last 18 months, international stocks ended the year up 14%. So double-digit returns in the rest of the globe for a globally diversified portfolio as well. We also saw emerging market stocks up 8.3% by the end of the year. And we also saw the Dow Jones up about 13.7%. So big year for stocks, interest rate, a lot of interest rate movement, causing a lot of change in the bond market as well, especially through the end of the year. Bitcoin, by the end of the year, had quite a rally as well. Looking at the change from January through December, it has gone up 153% as well. So a little bit more return to taking on risk, you could say, during 2023, despite that the fact that the journey there was filled with quite a roller coaster. Inflation starting the year at 6% has steadily come down to 3% in December. So that rate of change coming down just as the Federal Reserve wanted to see as they were raising interest rates to try to combat that, that caused the Federal Reserve to pause their interest rate hiking cycle. So at the beginning of the year, every meeting they were bumping up their interest rate about 75 basis points a meeting. And by July, they hit the brakes on that and have paused ever since. They didn't lower them, but they stopped raising them as well as they saw inflation started to fall down. I think as for us, as I look back at how we managed money throughout 2023 and this roller coaster, we started the year as a firm pretty cautious. We wanted to be pretty protective for clients, and as far as bonds go, we had a lot of short-term bonds because they were paying the most, and we saw the Federal Reserve raising interest rates and wanted to stay out of the longer-term bonds that are affected by that more. So we stayed more in the short term, but like we talked about, with the 10-year interest rate hitting the 5% by the last couple months of the year, we started to take some of those short-term bonds and extend out into those longer-term bonds a little bit. As far as stocks go, we stayed pretty neutral. We stayed pretty neutral between international and the U.S., and within the U.S. between large and small companies and between value and growth companies. We kind of stayed equally weighted between the two of them. Maybe a little bit more value towards the beginning of the year as well, in just trying to stay between all of those categories, stay with quality companies that had high free cash flow and were able to raise their prices during the hard times and being resistant to hard economic times. So the year, very good year, roller coaster along the way. Ryan, it does beg the question, what are we thinking for 2024?
So as we enter 2024, first thing I would say, thank you, Brian. First thing I would say is we try really hard to not make predictions. It's very difficult, and we even talked about that in the monthly update newsletter if you're receiving those. For instance, at the beginning of 2023, there were no institutions come to mind that was predicting a 20% return in the stock index this year. But lo and behold, we hit that number. And so making predictions on which direction the market will go, just in general, it can be difficult, but especially the magnitude of that direction is even more unpredictable. So we try not to make predictions, but what we do try to do is to look at historical valuations and where are we today in relationship to what maybe is a normal valuation for both stocks and bonds and gold or other asset classes as well, cash, et cetera. So if we're looking at relationships today, as Brian mentioned, we're ending the year or now beginning the new year. Inflation's about 3%, getting pretty close to normal, right? If the Fed target is 2%, 3% might be a little bit high, but it's definitely off the highest levels. So that's getting pretty close to normal and declining. So that's very helpful. The Fed has rates still at 5 to 5.25. As Brian mentioned, they quit raising in July, but they haven't reduced them yet. So 5 to 5.25, we would probably call somewhat restrictive still, right? But the Fed has committed to beginning to lower interest rates, and the timing of that is still up in the air. With a strong economy, they might slow a little bit slower than some might want. But if inflation's coming down, the need to be restrictive is decreased. So Fed policy right now we see as still somewhat restrictive at 5 to 5.25, and you can feel that with mortgage rates or a car loan or credit card interest rates that are pretty high. That's restrictive slightly on the economy. Stock valuations, as we rode the roller coaster last year, have bounced from somewhat expensive to then fairly valued. But now as we enter 2024, there's certain areas of the market that are fairly richly valued, so slightly expensive. And there's some areas of the market that might be more fairly valued, but it's very hard to find today areas of the stock market that are inexpensive or cheap or at very low valuations. So there's not much of a disconnect there that gets us extremely excited about potential great returns. All right. In October, as Brian mentioned, as we were hitting some lows in the stock market, I got pretty excited. We all got pretty excited about potential returns going forward because valuations looked good. Today, some of those valuations have started to creep up again. And so we enter 2024 with a little bit, I guess, reduced expectations for immediate returns because valuations are a little rich. Bond rates, as we start this year, 10-year Treasury is now at 4%. So it's come off the lows that it's been at for a couple decades, but it's also not at 5% like we saw in October. At 5%, we are again very excited about longer term bonds, very attractive at 5%, we feel. At 4%, still good, but not as attractive as they were. So stock valuations, slightly rich, bond rates fairly neutral, Fed policy a little bit restrictive, inflation getting closer to average. We have two continued wars, one that's only been going for a few months, but now one that's been going for a couple of years. Geopolitically, that always creates some risk or kind of a distraction to potential economic growth around the world. And then we also enter this year as a presidential election year, right? And that creates some volatility that might not exist in every year. So as we enter this year, on average, your presidential election year starts off fairly slow. And I would see this year as being probably no different. With last year finishing so strong, I feel that some of the forward returns or some of the returns that could have been baked into the beginning of this year were probably pulled forward last year. And so to see a little bit of a slowdown or a breather makes a lot of sense. And we're already somewhat seeing that in the first week or two of this year's stock market as we try to digest the great returns that closed 2023. And now we're entering presidential election year. Valuations are a little rich. We've had a run up. Wouldn't be a surprise to see a little bit of a pause or some choppiness to begin this year. Presidential election years, though, typically finish fairly strong, and the average presidential election year is typically better than the average stock market year. So a good year, I keep saying the word average, a good year, though, typically to be an investor. Fed, again, as I said, has committed to lowering rates. That should help bonds do fairly well. If interest rates, can flatten out and you can earn our coupon over time at 4% for a 10-year Treasury, that's a good coupon over the last couple decades that we're still happy about. Again, not as excited as we were at 5%, but still a good coupon. And if they're going to lower rates this year and even potentially next year, there's still some good returns that could be made in being safe and having some good fixed income. I would see this year somewhat akin to how last year went. Last year was very good at certain points throughout the year, depending on what month you looked at it, but then was also very frustrating at certain months or even quarters, depending on when you were looking at it. But by the December 31st, if you look back over the course of the full year and you take out the ups and downs, pretty positive throughout the full year. I'm not trying to say that this year is going to be as positive as last year was, because last year was pretty darn good, stocks and bonds together. But I think we can get through the full year and look back and say, you know what, that wasn't a bad year. There were some times that were difficult. There were some times that were great. But all in all, when you put the full year together, I think things are shaping up in this environment to have a decent year as we move forward into 2024. When we put all that together, stocks and bonds and cash, interest rates, the Fed, valuations, our stance today, as we enter 2024, is to be fairly neutral. We're not overly excited about stocks. We're not overly excited about bonds. But on the flip side, we also aren't very pessimistic about either also. I don't think that either are put in a position right now where we need things to go perfectly. The Fed is trying to walk a fine line of creating a soft landing, you hear that term, and trying to manage interest rates where they lower them just enough that we don't enter a major recession, but keep them high enough so that inflation keeps coming down. And that is a difficult line to walk, to have a soft landing and maybe not enter a full-blown recession. We wouldn't be surprised to see somewhat of a recession at some point. And that would be, we're prepared for that. And that's taking a neutral stance and not trying to predict great returns, but also being prepared for maybe some difficult times. Stocks haven't done much, though, over the last 2 years, right? So a lot of times we're hearing like, well, we're going to have this huge decline because of we're borrowing so much or with all this free money. And the Fed has been tightening that, right? And so could we have a decline? Yes, we always could. We could have a pullback. But when the stock market hasn't made any money for 2 years per se, it's hard to see another large pullback because it's not like we've had a great market that we're going to come back off some peaks. So I guess that's where I would try to keep a good balance, and that's where our policy comes in today. We're fairly neutral between stocks and bonds, and trying to put some more areas of funds in the areas of the markets that still do hold some good value and are not the richly expensive areas of the market. So that's where we stand for 2024. Again, not making predictions on the year, but it's something that we constantly monitor, and we do like to be nimble, trying not to lock into anything that we're stuck in for a long period of time, because markets do move, and we want to be able to be nimble and try to go where we see value, even if it's in the shorter term, because they do move, and they've moved quite a bit over the last year. With that, we'll turn it over to Kennedy, and we'll see if we have any questions from you.
We did have one question come in, and it says, for someone with retirement investments, is it better to invest in funds and stocks that give off income dividends and capital gains rather than growth stock and funds?
Okay. Brian, do you want to take that one, or do you want me to take that one?
I'll just give my 2 cents and you can add yours too. Okay. I'll say that I think it all depends on the goal, right? Even in retirement, with people living longer and longer, there's different stages of retirement. And some parts of your portfolio need to be a little bit more longer term focused and still have some growth oriented type of companies, and some parts need to be a little bit more focused on providing some stability and some current dividends and interest. So I think the classic answer that both can be a piece, and it depends on your goal.
Yeah, I would add too, if you think of the long-term stock return at about 10% in the S&P 500 or 10.5%, depending on the timeline you look, but the very long-term return, about 10 to 10.5% in the S&P 500. The dividend yield on average has run between about 2 and 2.5% on the S&P 500. So you think about dividends and what they mean to a portfolio, that's a meaningful portion of the return. So having some growth stocks that maybe don't pay as much dividend, but have some potential for longer term growth, usually carry a little bit more volatility, but then also marrying that with a good dividend portfolio that's kicking off 2 to 2.5%, because that is a meaningful portion of the average return over time. And so that's something that we balance. Sometimes we might lean a little bit more towards those dividend paying, steady stocks, typically a little bit less volatile. And sometimes we might lean towards more of the growth stocks. Today, we're being pretty neutral between the two. Last year, we saw great growth stocks do well. Dividends were a little slower. But on the flip side, in 2022, it was exactly opposite. And dividends did fairly darn well while the growth stocks suffered.
And then there's one more question, and it says, do you invest differently based on who might win the election?
I'll start with that. I think Ryan covered this a little bit earlier, that typically, actually, in history, the election does not affect the market as much as you would think, and it's actually usually pretty positive by the end of the year. So we try to make decisions based off of where is the best value for your dollar and what's going to match the goal that you need it for. If we invested based on what politics we're doing, we'd be swinging back and forth. I mean, the last 10 years, we've had swings back and forth with different types of presidents, and yet the market has still grown. So I think this is a common question on people's minds because this is an election year. There's a lot going on with that. But ultimately, if we invested at the whims of politics, I think we would not be successful as just taking a long-term approach and ignoring the noise and focusing on the fundamentals of what are companies doing, what is the economy doing, and where is the best value for our dollar. So essentially, no, we have to pay more attention to the basics of investing and take a longer term picture.
Any other questions?
Yep. If January is a positive month, does that mean the end of the year will be positive?
You see that a lot where January becomes kind of the indicator for the market, and people like to kind of make that the barometer for the year is how January goes. And we've kind of done this before, and I've heard these conversations before. January is the beginning of the year, so sometimes you feel like can set the tone, and how January does can affect the year, but it also every month can affect the year because January is one of 12 months in the year. And so if you know that January is positive, well, you have 1/12 of the year that is positive, guaranteed and locked in. And on the flip side, if January is negative, well, you have 1/12 of the year that is guaranteed to be negative, and now the rest of the months have to make up for it. So I don't put much stock, pun intended, I don't put much stock in the January effect being the barometer for the year. It can be a good start to a year. It can also be a detractor for the year. But it makes up 1/12 of the year, just like every other month makes up 1/12 of the year. So just because January goes one way or the other doesn't influence our thought process on the rest of the year. Any other questions? Okay. Well, thank you for joining us for Capstone Coffee Conversation. It's always good to see the people that are tuning in and listening to these. And we try to just give a little bit of market tidbits or information on things that we're hearing from clients. So we appreciate you joining us. And Brian and I look forward to seeing you all next month for our next Capstone Coffee Conversation.